Hi, and welcome back again to Tim Bigham's Big Time Options, Edges, and Hedges. Taking a look today at SPX Global, SPGI, and whether it's finally time to be a little bit bullish or certainly not as bearish on SPGI as the technicals, fundamentals, and IV point to perhaps finally a low being put in SPGI. So let's jump in and take a look. As we always do, we like to use our fusion approach, taking a look at the fundamental, technical, and probably most importantly, IV analysis. So taking a look at the fundamentals, quickly pulled off two of the charts here, the price to sales and price to equity, or PE and PS charts. You can see on a PE basis, SPGI now trading under 28 for the first time since going back to late 2022. We'll take a look at the chart in a second, how that coincided with a significant short-term low in the shares. You can see price to sales now at by far the lowest multiple over the past 5 years, trading finally under 8 times price to sales for the first time. So certainly valuations getting much cheaper. And the reason? It's beaten basically over the past 3 or 4 times on earnings, right, with upside surprises. Even last earnings basically came right in line, yet the stock got absolutely taken out to the woodshed. So better than expected earnings with a big drop in the stock price leads to much more attractive and lower valuation multiples, as we can see here. Taking a look, as we said, at the technicals, you can see the stock absolutely got ripped, right, as it was trading over the 500 level, basically to almost end January, kind of start February here, and then we saw this huge pullback, right? The shares trading briefly under 400, looking like they might be finding a floor here. This sort of doji reversal pattern, many times a sign that the selling has gotten overdone, right? A key reversal pattern, right? And maybe the buyers are back in control here. You can see on almost every technical metric, certainly shares deeply oversold. 9-day RSI got under 10, but is now back above that 20 level. So certainly finally starting to strengthen. As we always like to say, we wait for the curl, right? We won't jump in front, but we like to see the market tell us that maybe we're finding some support. MACD certainly at the lowest level over the past year, strengthening as well, finally lifting a little. Bollinger percent B reached the lowest level over the past 12 months, now went briefly positive. So certainly the technicals all lining up, shares trading at a massive discount to that 20-day moving average. As we talked about valuations, right? The valuations here in basically October of 2022 pointed to a significant low in the shares. We can simply stretch out the time frame here on the chart, and you can see that here is the last time the valuations were this cheap, right? On a PE basis, marked a significant and the lowest level in the shares over the past 4-year time frame. So certainly the technicals pointing to maybe the lows being in. Here you can see just how deep MACD got to an extreme. 9-day RSI at the lowest level over the past 4 years. You can see Bollinger percent B got tomahawk chopped to the lowest level over the past 4 years, but finally all of these strengthening. So setting up maybe for a period of consolidation in the shares. We can take a look at that IV as well. We always like to look at that. Here you can see that run up in front of earnings, right? And as we said, earnings came out on February 10th and basically came right in line. Certainly maybe a little drop in the stock would be warranted, but not the price action we saw. But IV really didn't pull back post earnings, didn't have that vol crush that we normally see. So IV remains elevated, finally starting to soften just a little bit here. We like to see that. Again, we don't want to jump in front of that moving train, right? But we wait for it to slow down where we can take advantage of it here. And here you can see that normal run up pre-earnings on February 10th where IV was over 30 and then still hanging basically around the same level. You can see back about a month ago, IV at a much lower level. So IV inflated here at the 68th percentile. So makes option selling strategies certainly very viable. So I went back to the last time the stock was trading at a similar price versus today and kind of took a look at the two trades. So I went back to April 17th when the shares were at 408.56, as we said, closed at 409 and change on Friday. You can see that the 65-day till expiration 350 put, right, closed at about $2.50, a 30 IV. Fast forward to Friday, right, with the stock a little bit higher, 409.54 versus 408.56. So basically a dollar higher on the shares, right? Less time to expiration, 3 days less. 65 back in April of 2024, right? The last time it was at this level. 62 on the comparative date on Friday, right? But you can see the price of the put basically double the value, right? Closed at about 475 back here at about 250, so almost double the price. Why? IV back then was around 30, IV now at over 38. So you can see that 350 put, which was a little bit further out of the money by a point, right, with a few less days to expiration, closed at basically almost twice the price, over $2 higher. So certainly selling some puts to basically position to be a buyer on further weakness makes a lot of sense for those who like put selling. For those who like more defined risk trades, took a look at the put spread, same idea here. So went on a little closer to the money because we do have defined risk. So the same idea here. April 17th stock at 408.56. That June 370, 360 that we're buying for protection put spread closed at about $1.12 or so, right? With the IV right around 26. Fast forward to Friday, that same put spread, which is a little further out of the money, right? Stocks a dollar higher, a few less days to expiration, close to $1.60 at a much higher premium. Why? Because IV shot up from 34 or from 26 back then to 34 now as far as that 370 put. We can do a comparative here. The return now, if we did it at that price, you'd make about 19%, right? Bringing in $1.60, risking only 840, right? 10-point wide spread, selling the 370 put, buying the 360 put, but you're bringing in $1.60, so you're risking 840 or potential to make 19% return. Your downside 39.5 points. The IV at 34.71. Go back to the last time the stock was here, it was actually a dollar higher, right? Or a dollar lower, I should say, back then. So closer to the money, but your return would have been much less, right? You could only gotten about $1.12 for that trade, risking $1.10 or 888, excuse me. So your return would have only been 12.61%. So you're able to make, in essence, 6.5% more return on the trade, or 50% greater return, right? With a bigger downside, right? You have a point bigger cushion, right? And a few less days of expiration. Why? Because IV has just absolutely exploded because of this big sell off here in the stock. And as we said, it's looking like it's finally forming that bottom, right? From a both technical and fundamental perspective. Certainly on the technicals, shares strengthening here, and the fundamentals pointing, as we said, to the stock getting to the lowest valuation we've seen in a very long time. So we're not looking to jump in right here and buy it, but on a further drop, right, of another, in the case of the naked put, over 50 points, right, or over 10% further drop, we wouldn't mind being a buyer there, get a bigger premium for that naked put, or a further drop of roughly 40 points or a little less than 10% at put spread, get a much bigger return. So that's how we go about identifying trade opportunities here at Big Time Options. But as we always say, trading is all about probability, not certainty. So make sure you position size accordingly, know where to get out when it has time to either trim down the position or take it off. Manageable losses are the key to long-term success. So until next time, as always, here's the good trading. Take care.